Hi guys and welcome to the channel. My name's Sam and I'm a property investor and deal sourcer based in the northwest of England. Over the next few weeks I'm putting together a training masterclass to help you guys make informed decisions when it comes to your property investments. And today we're going to begin with the buy-to-let strategy, which is the most boring, vanilla strategy and one of my personal favourites. And the reason why I love buy-to-let is it's incredibly low risk, low maintenance and high return in comparison to every other investment class. Now that doesn't mean it's the highest return property investment strategy, but it is one of, if not the safest. Now you may have heard that buy-to-let is dead with current investment rates with current interest rates at 6 to 7%. And in order to answer that question, today we're going to go through an example with current interest rates, the assumptions we make when assessing a deal, and how to set up a company's ownership structure to avoid the worst of Section 24 tax legislation. And so without further ado, let's begin.
Buy-to-let comes under planning classification C3, which means technically up to 6 individual persons can live in a buy-to-let property, unless it's in what's known as an Article 4 area, where the local authority has removed permitted development rights. And this is something you need to check before planning investment in a HMO, and something we'll cover in a later video. Currently, there are over 2.6 million buy-to-let landlords in the UK, making it by far and away the most popular investment strategy. And despite what you may hear, there's actually been an increase in rental demand in 2022, with a 23% increase in inquiries through Rightmove. This increase in rental demand is driven through a combination of high house prices and interest rates restricting home ownership, alongside immigration to the UK over the previous 3 years, as we've been through a housing boom cycle. Historically, a housing boom has always been followed by a slump before recovery, and the Office for Budget Responsibility forecasts there'll be a 9% decrease in house prices in 2023. And we're seeing this already, with estate agents now encouraging offers of 10% below market value, where previously, 6 months ago, they would have advised you wasting your time. This increase in rental demand and decrease in house prices has created an incredible buyer's market, making it an amazing time to invest in property, including buy-to-lets. Buy-to-let makes you money in 3 key areas. The first being rental income, which varies based on area, typically in line with property prices. The second is capital growth, which is the key difference between property and other inferior investments. Capital growth has averaged around 6.5% annually over the previous 10 years across the UK. And in areas of Liverpool and Manchester where I look for properties, it was 20% in 2022. Now, the amazing thing about capital growth is that even though you only own 25% of a property on an interest-only buy-to-let mortgage, you get to keep 100% of the capital appreciation when it comes to refinancing or selling the property, which is just incredible when you think about it. And finally, we have rental income growth, which has historically been higher than inflation. Even in 2022, where we had the highest levels of inflation in my lifetime at 11%, rental income growth still outpaced inflation, being 12% overall across the UK. These 3 key areas, rental income, capital growth, and rental income growth, are why buy-to-let has been such a good investment historically and still is today. And next, we're going to go through how to test demand for rentals in any area of the UK. My first port of call when it comes to checking an area's rental demand is to look on Rightmove, which will allow you to see the price of properties listed in an area and how quickly they've been let, which is really simple, as I'll show you now. If we just have a look in Preston, which is near to where I live, and we go and look for a 2-bed property that is somewhere near the town centre. So we go over to map view, zoom in near the train station in the town centre, and we are going to look at 2 beds only, imagining we are going to look for a property somewhere near the train station in Fishergate. If we just hover over these properties, you can see this 2-bed apartment's been let for 910. That's been on the market for a long time because I saw it a few months ago. This one's on for nearly 1,000 for a 2-bed apartment. This one's on for 900. So you can see if you want a nice apartment, modern with a modern finish near the train station, you're looking at around £1,000 a month, which is quite expensive for Preston. So that tells us the price of properties in that area. But if we want to get a feel for how quickly they've been let, we can also just go into filters and choose include let agreed. And you can see that there are 196 results including let agreed, and that is properties where a tenant has submitted an admin fee or deposit and the landlord is reviewing their references and performing the necessary credit checks. So essentially those properties that are in the system with the paperwork submitted but haven't been completed yet. And 2 or 3 months ago in this sort of area, you might be seeing roughly a 50-50 split between the number that have let agreed or that are available on the market. And now it's gone to about 75-25%. And what that tells me is there's actually less properties been taken up. It's that the market's actually slowed down in the area over the last couple of months, which is not surprising really in the run up to Christmas. But the higher the percentage that include let agreed, as a rule of thumb, the higher the demand. Sorry, the quicker the take up of rentals in an area. Alternatively, if you want to invest a little bit of money, you can use a software system called Property Engine, which I'm a huge fan of, and that will tell you really accurately down to sort of street level and really easily um, which properties have been let and at what price. So if we focus on the same area near the train station in Preston and we hover over some of these properties, you can see that this was on in December 22. It was let at 795. Scroll in again. Down Westcliff Road here, you have some nicer properties. See 850, 950, 1000. And if you were looking to invest in an area, you'd be looking at what's the finish going to be like in the property that I'm going to invest in, or what's the level of upgrade that I'm going to apply to the property, and how would it stand out versus other properties in the area. So if you take an area like this near the train station, it's actually quite high rental value. You'd need to finish a property to a very high standard in order to sort of stand out in that area, and that's just something you need to be aware of before you invested. Another great thing about Property Engine is that you can look at the demographics of an area before you choose to invest. So if we take levels of crime in Preston, you can see that as with most areas, it does typically get higher the closer to the centre you get. Obviously, all the sort of nightlife crime that goes on there. But if you were looking at one of the more suburban areas, you could get more of a general feel for levels of crime in the area, and also levels of deprivation based on the income of the people that live in an area, which has an effect on rental prices. It also has an effect on the amount of maintenance you need to budget for. So yeah, and lastly, and most importantly, you need to call a local letting agent. And this is the most important step. I'd advise calling sort of 2 to 3 letting agents in an area if you're looking to invest in a rental property, and just say, hi, I've got a 2-bedroom property on X street. What's the typical rental price in this area? What would you advise we put it up for? And how quickly are properties being let at the moment? And you'll usually get a straight answer. So yeah, local agents always the best bet and most important step. Now we're going to look at an example of a really nice 3-bed end terrace property I recently surveyed in Liverpool. The agreed purchase price was £120,000, of which under a 75% loan to value mortgage would require a £30,000 deposit. This would be an interest only mortgage where you only pay interest on the amount you borrow, which in this case would be 6% of £90,000. So our total money in includes a £30,000 deposit, £1,000 solicitor's fee, £500 broker fee, 3% stamp duty, which you pay on all investment properties, and a £3,000 sourcing fee. Therefore, our total money in is £38,100. Now that we've calculated our total money in, we need to estimate the property's potential return. Currently, The property has a tenant in situ paying £800 a month, which if we times by 12 will give us our gross annual rental of £9,600. Capital growth in this area has averaged 8% over the previous 5 years, which on a property value of £120,000 will give us an additional £9,600 in year one, compounding over time. And what this means is that in year two, the property should achieve 8% capital growth on £129,600, which is equal to £10,368. And so the difference in compound interest between years 1 and 2 is at first only £768. However, by year 10, this difference has increased to over £9,500, with a total property value at £240,000. If you add up compound interest across a property portfolio over time, it's equal to serious money. Buy-to-let expenses include interest repayments on mortgage debt, which is 6% at current market rates. We've also included a 12% management fee from a local letting agent, including VAT, and maintenance fees are 5% of rental value, which will give us our total annual expenditure of £7,032. Net rental income is gross rental income minus expenses, which in this example is £2,568. This is a tidy return on investment, achieving 6.74% return on capital employed. However, if we were to include capital growth, which is real money when it comes to refinancing or selling the investment, then our return on capital employed is 31.94%. This is equal to just under a 3-year payback on your initial investment, on your initial cash in, which is just incredible when you consider that this asset will keep on returning value year after year for the next 50 to 100 years across generations. And so when you take in capital growth and you look at the full picture, you would have to say that buy-to-let in this example is still a good investment despite current mortgage interest rates. One of the main concerns with buy-to-let in recent years has been the introduction of Section 24 of the Finance Act 2015, which has been fully enforced since April 21. And what this means is that landlords who own property in their own name can no longer claim tax relief on mortgage interest payments above the basic rate of tax of £37,700. And as most landlords are higher income rate taxpayers, this has had quite a significant impact on their earnings. And whether this is fair or not is a different question, but the fact is 47% of landlords have changed their investment plans due to this legislation, and the worst affected groups are those with only 1 to 2 properties, as they're least able to absorb the costs. Thankfully, there is a solution, which is to buy property as a limited company. It only costs £12 to set up with Companies House and takes 10 to 15 minutes, and then you can offset your mortgage expenses as a legal expense, and you only pay 25% corporation tax on profits. You'll still need to pay income tax on any dividends that you withdraw from the company, but at least your mortgage costs are accounted for, and more banks are providing mortgages for this type of investment strategy as it's becoming increasingly common, especially with new property investors.
So, is buy-to-let dead in 2023? I think we can see that buy-to-let can still be a great investment. Rental prices are strong, and the lack of demand and increase in supply will make sure that your investment is a safe bet. Now, you can definitely achieve higher rates of return for serviced accommodation and HMOs, and I would recommend those strategies above buy-to-let if the property has the correct attributes, but their success does vary based on area, where buy-to-let is probably the most widely applicable rental strategy and works almost anywhere. But as with any property investment, the key really is to find a great deal. And if you're looking to get into property and would like to have a conversation with me about our bespoke property deal sourcing services, then please just fill in the link in the description below or send me a direct message and I'd be happy to have a conversation. You can also sign up to our investor list to get first access to direct-to-vendor off-market deals. And so, without further ado, thank you guys for watching, like and subscribe, and I'll see you next time.